Time for our weekly market review where we analyze the stock market to see if a correction or crash is coming. Because as you know, to be successful in the stock market, you gotta manage your risk and look at that downside. And that's exactly what we help you do here at Fallible. That's why you're watching this video. So first we're gonna go over the market, then we're gonna talk about a few stocks that we're looking at that you should probably add to your watch list. And then we're gonna have a quick strategy session about how we're playing these markets going forward, because things are definitely getting a little bit dicey here. Now, as always, we got our research from Macro Ops to help us, which is our global macro research and consulting firm. So you know it's that good stuff. First thing we can look at right here is the household ownership of equities as a percentage of financial assets. So this is just to give us an idea of how invested are people into stocks. So you remember when we talk about sentiment in most of these videos, we say when it's super bullish, it's actually bearish for the stock market. Because if people all think stocks are going to go up, then all their money is piled into the market, and then who's left to buy? Where if people are super bearish, that's actually good for the stock market, because that means there's a bunch of people on the sidelines still waiting to invest. So this is kind of another way to look at that. What is the household ownership of equities? Well, right now it stands at 43.2%, which is just shy of the all-time high reached in 2000 of 44.6%. And look at that, the all-time high was reached in 2000, and you know what happened after that. So we are getting there in this market. This never-ending bull market that seems like it'll never go down. Well, these indicators are continuing to go up, and we will reach there eventually. Here's a chart of NDR that shows household financial assets versus income. Once again, you could see we are at record highs. So everyone is heavily invested in the stock market by this point. So in the past, this equity ownership of percentage of financial assets, it was actually a pretty good indicator of what the returns would be of the stock market going forward. You can see here in this chart, it goes back to 1966. It's showing the returns then in 2000 and 2008. So if this relationship holds, then there's a good probability that we have a negative 0.5% annualized market return over the next decade, which would not be fun. Sideways markets, people get sick of them real quick. Now, if you have a good system like we do, it's a different story. The sideways markets are just fine. But, in our 401ks and whatnot, this is not a good annualized return. And for anyone who's buy and hold, it's not a good look. And I remember here in the 60s and 70s, the market really did go sideways for a number of years. I think it was multiple decades even. And we always talk about the Japan example, right? Because their market collapsed and didn't recover for the longest time, like over 30 years. But the same thing has happened in the US in the past. So once again, that's when buy and hold kind of breaks down. For most of the time, it's great. It works great as long as you could hold through a crash, which, I actually don't recommend buy and hold because most people can't execute on it. But let's say if you could execute perfectly, then yeah, the buy and hold would work. Unless we get into a Japan situation or a situation like the 60s and 70s, and the same situation that we could be facing now. Goldman Sachs risk appetite indicator is close to an all-time high. This once again goes back to what we talk about with sentiment. People are ready to buy more and more, which could be a bad sign. So Goldman Sachs says that a high reading on this indicator means the likelihood of very strong S&P 500 returns is usually lower. Again, that's that sentiment analysis that we just talked about. But the risk of a very large equity drawdown is also usually lower because there's likely a strong macro backdrop that has boosted risk appetite, similar to the COVID-19 recovery. So they're saying if people are so bullish, then they're likely bullish for a reason. And if that reason is a strong macroeconomic backdrop, then it will kind of stopgap any huge collapse in the stock market. Nevertheless, there is more negative skew of returns and the probability of corrections increases. So this fits with our current base case in macro ops, which we talked about last week. It seems as though we will probably get a buy climax over the next few weeks, maybe even months, followed by an extended period of sideways chop and volatility in the US markets. So we showed you guys this chart before with the S&P closing above its March upper trend line. So when it's doing that, when it's breaking the trend to the upside, that's when you could kind of expect a buy climax. You could kind of see the same thing on the weekly chart right here. It has broken above this huge widening wedge. So things could really run from here. But after they do run, they come back down and they're going to chop sideways. Now, if we look at the Nasdaq right here, it is deeply oversold on a relative basis compared to value stocks. And whenever things get out of whack like this, they usually revert to the mean. Meaning when something has a huge run, you usually see it collapse after, right? Because it's going back to the average. Same thing happens if something is really beaten up, you might see it rebound very quickly because once again, it's reverting to the mean. So if we look at growth stocks versus value, growth has been beaten up pretty bad. And you guys know the story so far with bonds just falling through the floor, meaning interest rates were shooting higher, which really hurts highly valued tech stocks because these analysts have to redo their models, and basically what happens is that these tech stocks get revalued lower. That's why they were falling so hard. But they're so deeply oversold now that they're due for a nice rebound. Here's another chart from Fairlead Strategies, which shows that the momentum in the Nasdaq is turning up. You can see these lines right here all poking upwards. And I don't know how much you even need to look at all those charts when you can just see here. We talked about this triangle forming, and we were saying if it breaks to the upside, that'll be a very bullish signal as opposed to breaking to the downside. Sure enough, it broke to the upside, and look, it's running. It blew through its 50-day moving average as well. This is all a very good sign. Every week now for the past month or so, we've been talking about semiconductors because they have just been taking off. So just recently, there was a big weekly price thrust in the SOX index, which is the semiconductor index. So it looks like a big rally is coming. And it also looks like this super cycle in computing power that we've been talking about for a long time now is probably going to become a mainstream narrative. Now, what's nice is when you're in before it becomes a mainstream narrative, because then it gets pushed up really high before, it eventually collapses. And this is what we talked about with the shift in the semiconductor industry. Instead of all the chips going into phones and computers, they're going towards AI. And with AI, you just need raw power. You need a ton of data and a ton of chips. And the chips hold the data, it's all crossover. But the point is you need a lot of hardware for the computing that you need to do with that software of AI. And the more the better. And the data needs are growing insanely fast. So that's a lot of demand for any of these semiconductor producers. And AI itself is kind of like a paradigm shift for this whole industry. It's not like it was before with the computers and the cell phones. This is a new source of demand that seems to be never ending. I mean, it will eventually end, but for now, yeah, it's pretty much never ending. Ticker symbol QRVO is one of the many names that's breaking out from nice technicals. This is one of the semiconductor stocks that we're looking at and one that you could add to your watch list. You can see it has a nice breakout from a pretty solid base here, long term. And remember, with bases and technical analysis, the longer term you're looking, the better off you're going to be. Because whenever you move to those shorter time frames, you're going to get a lot more noise. If you extend out, then it's going to be less noise, more signal. So if you read William O'Neill's book, How to Make Money in Stocks, with the whole IBD method, Can Slim, he always talks about using bases that are at least 5 weeks long. Because if you're looking at a stock chart, you can make a base out of anything. You could have a 2-day base, but the 5-week one is going to be more of a signal than the 2-day one. That's the interesting thing about markets. They're all fractal. You could trade them on different time periods. But unless you're a high frequency trader, you're usually better off going longer term. Last month, we were talking about the relative strength of Japanese financials, including Nomura, ticker symbol NMR. But as you remember from our video just a few days ago, we talked about the Archegos blow up, right? Well, NMR got nicely hit in that. They're on the hook for potentially $2 billion in losses. So they're one of the banks that got screwed while Goldman Sachs was just fine. So now its stock price has taken a big hit, but in reality, its credit is mostly unfazed, especially when compared to something like Credit Suisse, who was also caught up in this mess. They didn't fare so well. So the macro ops team is keeping an eye on NMR and may consider putting on a starting position once its technicals firm up some. So what we're really seeing by the market is an overreaction in this stock, which can be a good play for smart traders. Because remember what we were talking about before, when things get too out of whack, they always revert to the mean when it comes to markets. So here with NMR, if it's getting dumped and the actual internals of the bank are just fine, then you might have a play there. And you can kind of call it a value play or a grave digger play, but you're looking for that rebound because you basically think that the market got it wrong, they're overreacting, and then things should get back to normal. You can make money off of that. And it's not a bad play or a bad strategy because markets are always overreacting. Even with our momentum strategy at Fallible, which you all are very familiar with, we're still playing those emotional reactions of the market. Like when Tesla goes straight up for a year, does that really mean that Tesla is going to be worth that much in the future? And we talk about this all the time. Like, what is Tesla worth when you're in the trillions at a certain point? What's the difference between 1 trillion and 2 trillion? No one knows. But we do know it's emotions that drive a lot of these momentum names. The vision of the future. So it's the same idea. You're still playing those emotions and that price trend at the end of the day. So when it comes to momentum, we like to play it to the upside. But if you're a contrarian, you kind of like to play it the other way. A stock gets dogged on and then you jump in at the bottom. If you can do it, works out real well. At MacroOps, we were also very bullish on agricultural stocks. And that goes back to one of our previous videos as well, the agricultural trend. Because there's a lot of countries that are finally coming to the point where they could afford stuff like meat. Well, all those cows and whatnot got to eat a lot of grains, right? And just the whole food thing in general. There are a lot more people coming into wealth around the world. That food demand is going to shoot through the roof. One of the ways you could play that is through these agricultural companies, which we are tracking. One of them is a fertilizer company called CVR Partners. Partners. This is one we actually pitched back in January. The stock is up nearly 200% since then, which is why I go over these stocks in these videos, because they're not too bad to add to your watch list. They can sometimes work out really well. A new one that we're looking at is Bio Innovations, MBII. It's an agricultural biotech that hails from UC Davis, which is where Alex, our lead researcher, went to school. Now, it's early days for the research we're doing into this company. You can see on the weekly, it's almost breaking out. On the daily, it's kind of collapsing. So there's a lot of potential here, but we really got to dig too. So stay tuned for that. We'll give another update soon. Now, another interesting thing that I want to talk about is the fact that it looks like investors are getting tired of the stock market. Finally, after a year. I was talking about this with Alex actually a few weeks ago, because we not only notice it in the market, but we notice it in our businesses too. Like, I could tell if my views are going down on YouTube, that means something is up. Same thing on our research website, MacroOps. We could see how much interaction there is in our Twitter posts. So actually running these research businesses gives us another indicator of sentiment in the market. So we kind of had this feeling that people are pretty much burnt out with the market. Not only that, but things are opening up. Sure, cases are rising like crazy right now, but people are treating it like the pandemic is over. So people aren't going to sit at home all day staring at markets anymore. And sure enough, this article came out from the Wall Street Journal with data showing that investors have been retreating from markets. And a big reason why is because they've been losing. So I mean, going back to the Nasdaq here, look at this price action. This isn't fun. This isn't the straight up that we were getting before. This is volatile, sideways action. This is the same type of action that we expect to be seeing after this buying climax that we're talking about. And this is not the action that makes people happy. This is where you lose money. Now, I personally don't mind all these investors finally exiting the market, because they came in March of last year. At the bottom of the market, they made some money, thought they were geniuses. Not so much. But there's been so much noise in the market, constant noise. So I'll be happy for it to get a little quiet again. But before that happens, what's likely going to happen to all these investors is that, okay, they're leaving the market right now, right? But if this buy climax picks up and the heat is back in the market, they're going to get pulled in one more time, even though they just lost. There's a stat in that article, which I couldn't find just now for some reason, but they was saying that investors were down 10% since February. So again, the losses make it less fun as well. But if this buy climax happens and all these growth names start shooting up again, they're going to get drawn in. Once again, they'll make some quick gains until the thing turns around and it crashes a bit, and then we get that sideways choppy market. And at that point, all these investors will be absolutely fed up with the market. They don't want to touch it anymore. And this isn't some amazing prediction that I'm making here. This just happens time and time again to each generation as they enter the stock market. You know, I get so many comments on this channel that I'm always bearish. I'm always looking at the downside. Oh, you're so terrible, AK. And I'm like, no, I'm not terrible. This is how the market is. This is how you're supposed to approach the market. And when we have so many YouTube channels, you know, the same thing happened. Everyone jumped in the market and everyone decided, hey, I should have a YouTube channel too. But when all of them are so bullish, just constantly, never looking at both sides, then what's the point? Always got to look at that downside. But each generation goes through this, because the worst thing that could happen to you when you get into the market is that you make quick money fast. Because all of a sudden you think, hey, this is easy. And that's exactly what happened to everyone March of last year. Because then when you start losing over and over again and you realize, oh, this isn't easy, you just completely give up. But again, everyone has to learn this at some point, right? Markets aren't easy. Now, you guys know our system, right? Our momentum system. It rotates into the top 5 highest momentum stocks in the Nasdaq every month. And we get our little TSI scanner right here that tells us which stocks have the highest momentum. It spits out a number right here. Well, just last week, we made our rotation back into the stock market, because before that, we were all in cash. Basically, we were in cash during this crazy period. And lucky for us, as soon as we re-entered, the market really started rebounding here. I'm not saying we magically timed that and could tell the future, because if you remember in the previous videos, I was like, oh man, I hope this next rotation, the market goes up instead of collapsing. Luckily it did. But now what you're going to see here during this buy climax is how a good system works, because we are going to be taking profit on the upside for a lot of these names that we got into. And by doing that, we were systematically reducing our risk, because what did we say? After this buy climax, the market's going to collapse a bit and then go sideways. So when that actually happens, we would have taken most of our profits off the table, at least in the most, optimal scenario. That's why we set the system up that way, to take profits. So if these individual names that we're in collapse, which I'm sure they will, we will have much less exposure than another person who didn't take profits. So as I mentioned earlier in this video, a sideways market is just fine if you have the right system. Well, the right system doesn't mean just picking the right stocks. It means trade management. How are you managing those trades? Because picking the right stocks, that's only 10% of the game. The other 90% is the trade and risk management. So that's why I'm not worried about a sideways market, because I know we got it in our system. It's all a part of a good strategy. And as always, if you want to learn exactly how we're doing it step by step, then just check out our free training right here. I'll put a link in this video and down below in the description and comments. Same strategy I myself use and all our Fallible members use too. We are all very happy. So if you want to learn exactly what we're doing, just check out this training. And like I said, I'm excited to see how it does this month. It looks like we got lucky. Like, I'm not sure yet, anything could happen, but it seems like we re-entered right when the market is turning up. And again, if you want to join us, just check out the training right here. Definitely good stuff to learn. Whether you want to use our exact strategy or don't, it doesn't matter. You just got to have risk management in whatever you're doing. So click here and I will see you in that training.